With me in the studio, I've got Ed Stacey from Capital Network. Ed, good to see you. Good morning.
Hi.
Just a reminder, for Ed's full report, click on the eye in the top right-hand corner of your screen. Ed, we've had a trading update this week from Plastics Capital for the year to the end of March. First off, what's your view on the statement?
Yes, I mean, it's a year-end March, so the year's already finished now. They've put a statement out. The full results will be out in July, but they're giving us some detail now on exactly what to expect. Confirmation there is strong double-digit revenue growth, and that's very important because about a year ago, the group announced a new strategy to refocus on driving that top-line growth. And so here we have a statement confirming that, yes, that has come through in the sort of first year of execution. So positive in that regard.
Looking at some analyst expectations in the market, they've lowered their margin estimates, but interestingly on the day shares closed higher. What do you think's behind this? What's been driving that?
Yeah, so we slightly reduced, so this is for the backward looking year, for the year to March, we've slightly reduced our EBITDA margin forecast as well. But I think it has been well received, this statement, and it's important to think about the context and also the detail of what's in the statement. So in terms of context, we're 1 year into this new growth strategy. People are very much looking at, do they deliver that top line growth? And certainly, you know, profit margins are still important. We want satisfactory profit margins, and they are there or thereabouts. The fact it's slightly lower, I think, isn't the big focus. It's the growth that perhaps people are more interested in. But then in terms of the detail, when you look at where the margin compression has come from, a big element of that is mix effect. Because they have a lower profit margin business. The plastic films business is a very good business, profitable, but it's a lower margin than the group total, and that actually was the big growth driver in the year. The higher margin business within the portfolio is the bearings business. So this is plastic bearings assemblies that go into various appliances and so on. That's a high margin business. They'd signed some big contracts, big framework contracts, but the actual drawdown of units under those contracts has been slower. The customers have been slower to take up their allocations. So the revenue's been actually a bit slower than had originally been expected under those contracts. Now, the good detail in this latest statement, which wasn't in the previous statements, they are now saying that that slowness in those contracts is starting to work through, and also that they've got new contracts for the bearings. So we've seen, as they previously told us, the mix effect a bit negative in the financial year March 2018, with film stronger, bearings not so strong. But what we're now seeing is a bit of a correcting of that balance, at least starting to come through. So in a forward-looking sense, you're saying maybe we can have the revenue growth continuing and with better mix as well, which is certainly what we're expecting in the next couple of years.
So where does this all leave us in terms of Plastic Capital's valuation, Ed?
Well, the shares are on about 11 times forward PE, which when you think about this as a group which can now deliver both margin upside and that top line growth, we could get some pretty decent earnings growth on a sort of 3-year, 5-year view, and 11 times PE. So I would say it leaves us on a pretty interesting valuation here.
Ed, thanks very much. A reminder, for Ed's full report, click on the eye in the top right-hand corner of your screen.